Welcome to 7 costly mistakes to avoid when buying REO properties. In this brief video, we'll explore some of the benefits and traps that buyers often fall into when buying REO properties. We'll explain what an REO is, the foreclosure process, what makes an REO property attractive to buyers, and 7 mistakes that can cost an unwary buyer thousands of dollars. What is an REO? REO is simply an acronym for real estate owned. While it can refer to properties purchased by corporations from their employees, we're focusing on properties resulting from foreclosure. Sometimes you'll hear people talk about OREO. No, we're not talking about the cookie. OREO stands for other real estate owned. Whether it's REO or OREO, it all means the same thing. Before we get too carried away, let's take just a few seconds to explain foreclosure. Foreclosure is a process, not an event. The process of foreclosure can vary from state to state, so you'll want to check on the process in your area. In general, foreclosure is a 3-step process. The first phase is called pre-foreclosure. It's the period of time between when the homeowner misses their first payment and the sheriff sale or auction. Again, the amount of time can vary from just a few weeks to well over a year. It depends on what state the property is in and how aggressively the homeowner defends the lawsuit. It's during the pre-foreclosure phase that you'll see a property being advertised as a short sale, but that's a subject for another video. The second phase is the sheriff sale or auction. This is when the property is sold to the highest bidder. Buying properties at sheriff sale is not for the faint of heart or the novice investor. You're not allowed to inspect the property, and it's easy to get caught up in the excitement of the auction. Should the property not be sold at auction, the bank or government agency that foreclosed becomes the legal owner of the property. Why would you want to purchase an REO? First, if you're willing to do some homework, there are some bargains out there. Bank-owned properties can sell for up to 35% below market value. You'll have the opportunity to have the property professionally inspected. This can help insure against unexpected and costly problems. The bank or government agency that owns the property may offer attractive financing packages. Third-party lenders will often consider financing an REO since their appraisers get a chance to look at the property. REO buyers can also negotiate a financing contingency in their contract with the seller. By the time a property goes on the market as an REO, the former owners or tenants have already moved out. Sometimes the seller is willing to make repairs to their REO properties, returning them to a livable condition. Otherwise, the property will be severely discounted to help it sell more quickly. REO properties are almost always listed with a real estate broker or realtor. The realtor is bound both legally and ethically to represent the property truthfully. In some states, lenders are exempt from some of the disclosure rules, so be sure to check with your local realtor to find out. Now the part you've been waiting for. The first mistake to avoid is that not all REO properties are bargains. While banks are not in the business of owning real estate, they do have a fiduciary duty to their stockholders to get the best price possible. Also, the condition of the property is not their concern, so do your homework and work with a realtor that has experience with REO properties. REO buyers must know property values in the area, the condition of the neighborhood properties, neighborhood trends, and a myriad of other factors that affect the value of a property. Sometimes REO properties are priced below market value to attract multiple bids and drive up the sales price by starting a bidding war. Some REO buyers feel that a professional inspection is too expensive. Institutions most often don't have any knowledge of the property's condition and are often exempt from disclosure requirements. You'll want to have a licensed inspector inspect the property so that you can make an informed offer. You want to make sure that there is clear title to the property. Some tax liens can survive the foreclosure process. You'll want to make sure that the selling institution has already satisfied any and all existing liens against the property. The best way to do this is to have your title company do a professional title search. Some states also have a redemption period whereby the former owner can pay back the delinquent amount and reclaim the property. The fifth mistake you don't want to make is to not have enough cash. You'll need to be prepared to pay for closing costs, fees, and any unforeseen repairs, especially if you're buying an as-is property. You wouldn't be the first person to lose a property to foreclosure because you bought an REO but ran out of money before the repairs were completed. Mistake number 6 is not being patient. Do your research. If possible, learn as much as you can about competing bids, property taxes, utility bills, and any outstanding liens. Remember, take your time and do your due diligence. Finally, make sure you ask questions. You'll want copies of all relevant permits, receipts, surveys, and inspection reports if any exist. Be clear about brokerage fees and who pays them. Coldwell Banker Select Professionals is a leader in South Central PA for real estate. We have offices in Lancaster, Hershey, Ephrata, York, Camp Hill, and Hanover. We also have a team of real estate professionals who specialize in foreclosure properties, both pre- and post-foreclosure. Finally, our relationship with attorneys, lenders, inspectors, and contractors gives you, our client, the edge in not only finding your real estate, but guiding you through the negotiations and the closing. Thanks for stopping by.